All right, here we go. Welcome back, everyone. Crypto Profit Accelerator. We are on day 6. And as promised, today we're going to get into tactics and tools. All right, so remember, we talked about principles, frameworks, strategies, tactics, tools. Even though tactics and tools is the thing that everybody wants to start with, it's the thing that everybody wants to jump in right away, not only in crypto or investing, but with anything in life. Just as humans, we tend to want to be like, just tell me what to do. Like, let me go take a martial arts class. Just show me how to kick. And every grandmaster is like, well, no, we'll get to that, but you got to understand a few foundational principles. You got to understand how to breathe. You got to understand how to control yourself, your own body from the inside out. Then we'll teach you the technique, the tactic, kicking, punching, flipping, whatever's involved, depending on the martial art that you're taking. It plays out in the fitness realm too, right? People go, just like teach me a bench press or teach me a kettlebell swing. Well, there's a few foundational things that you have to understand first. So this is no different, just in the sense that, hey, we've put in the work. We've done 5 days up until this point. We talked a little bit about the foundations that need to be in place so that when you start implementing the tactics using the tools, that you're not going to get wrecked in the process and so that the actions you take are actually contributing to a bigger picture strategy, which is informed by the frameworks and principles that govern the whole thing. Okay. I'm not going to do a huge recap today because you can go watch the other videos, take a look at that, and we'll dig into the tactics and tools today. All right, let me share my screen. And this is Crystal. We'll get into this in just a second, but I want to cover a few bases here. First, tools. Okay. The one tool that we're going to use primarily today is called Crystal. All right. When I first set up a position on Monday, Sol USDC, we used a tool called Orca. Orca and Crystal are both what are known as liquidity management platforms. So in a sense, they are a UI, a user interface that allows you and me as the user to interact with various decentralized exchanges that are located all over the place. So Crystal, Orca as a tool, Crystal in this case, aggregates existing data. All right. And that's important to know because a lot of people think like, oh, I'm depositing on Crystal, or how do I put my money on Crystal? It's not what's happening here. You're using Crystal as a user interface in order to leverage other DeFi tools, for example, Uniswap on the Arbitrum network, which is what we'll take a look at today. You can leverage those other tools without actually having to go directly to them. Now, the benefit there is that you can manage your entire portfolio across multiple decentralized exchange platforms. You can do that all in one little bundle rather than having to check on 12 different positions on 12 different exchanges and they all look a little bit different. And now you got to learn 12 different tools. So the premise here is that this one tool, and again, there are many like this. We got to start somewhere. So I'm giving you one example. It will help you to simplify the organization of your portfolio. But again, if you don't know what to look for, if you don't know what to do, you're not sure of what your strategy is, the tools, it's not useless, but it's going to become chaos very, very quickly. Okay. So now we're going to take a look at a few things, and I'm going to show you this on the actual platform. But there's a few variables we have to take into account. We can't get into the nuances of every single variable here today. Again, just for the sake of simplicity, I'm going to show you a few like basics how you would navigate this. Number one, obviously, is going to be APR percentage. This is not the be all end all, okay? Yes, we talked about 50 to 100% APR being the target range that you're going for. But if all you look at is APR and you filter the information, I'll show you how to do this in a second. You filter the information by highest to lowest APR, you're going to get these 2,000, 3,000%. So you're going to go, oh my God, I'm going to be rich. but that's not the only variable at play, okay? But percentage APR does matter. And when we look at this in the tool that we're using, you will get an estimated APR quote, okay? And that's critical because all of this, you're going to look at this and go, oh, I'm guaranteed 90%. No, you're not because it's based on, like we talked about before, daily trade volume, which is another variable that we'll take a look at. But they're going to give you an estimated APR percentage. So it's going to say, hey, we're estimating based on maybe the previous 7 days, maybe the previous 30 days. We're going to estimate what your yearly APR will be. Okay. What are they doing? They're taking the daily APR and multiplying by 360 and then displaying a number. Okay. So remember on Orca, it just gave us the daily. It says 0.27. And you go, oh, I can do the math and multiply by 365, and that equals 100% APR. Great. Well, this user interface, you can arrange it so that it displays, it's expressed as a yearly APR. But again, we don't want to get caught up in the hype because something might express as a 3,000% APR today, but if it's a crap asset and it tanks and there's no trade volume the next week, it's going to go down to 2% or something like that. Okay. So the point is, these will fluctuate. So we want to be aware of not only what is the APR percentage, but the next thing will be trade volume. And typically, this will be expressed as a 24-hour trade volume. And you're like, well, geez, that's not very reliable. But it is. Because if you're watching certain pairs over the long haul, you can see, oh, the 24-hour trade volume, it might fluctuate a little bit, but it is pretty steady over the long term, all things considered. So daily trade volume is actually a very useful factor to take into consideration because you want that trade volume to be high enough that it generates enough trading fees that can be distributed across all the liquidity providers. And then you go, well, hold on a second. How many liquidity providers are there? Well, that's expressed as TVL, which stands for total value locked. Total value locked is simply how much liquidity is being provided by all the liquidity providers in that one pool. Then we're going to look at the ratio between these two. So we're going to look at the volume to TVL ratio. Why does that matter? Because we want to get a cut of the trading fees. So if there's a $1 million pool and I'm providing $10,000, I have 1% of that pool. Nothing wrong with that. But if that $1 million pool only has, I'm just making numbers up for illustration, if it only has 20,000 in trade volume, well, guess what? There's not going to be very many total fees to distribute across all of those liquidity providers. And therefore, your 1% take won't be that high because the volume to TVL ratio is low. Now, on the flip side, if you've got a pool that's a million and you're providing 10,000, you have 1% of the pool, but that pool does 50 million in daily trade volume. Holy cow. Now the trade volume to TVL ratio is 50 to 1. That'd be insane, by the way, to find a 50 to 1. What we're looking for ideally is 1 to 1 or better. Okay. Now there are other factors, but just sort of as like a loose parameter, a loose rule, that's a pretty good-ish standard to keep. So if there's 20 million in TVL and the daily trade volume is 25 million, you go, that'd be pretty good. Now you got to take into account the fee tier as well. But in general, when you hit that 1 to 1 or better ratio in a blue chip pair and a reliable asset pair, then you will typically land, in all likelihood, again, not a guarantee, you'll typically land in that 50 to 100% APR. Okay. So let's take all of this and let's put it into play. Okay. Yes, this is part of strategic, how to set it up, but now we want to get tactical. Okay. So here we are looking at crystal. And I am in, this is you'll notice up here, I'm in the hot pools section. Okay. And I have selected the Arbitrum 1 network. You can select all kinds of networks here. You can even select all of them at the same time. All right. Again, in the interest of simplicity and just demoing for you one possibility, we're going to start on the Arbitrum network because there's a lot of good pairs here. There's increased interest in trade volume here, and the fees on Arbitrum are a lot lower than the Ethereum network. So yes, the Ethereum network typically will have the most total TVL across the entire network, but it also can get pretty pricey on the fees. Now, the flip side of that is if you're a liquidity provider, you get more fees, but you end up paying a little bit more, so it kind of balances out. So anyway, Arbitrum, good place to start. And you'll notice right away it gives us best blue chip pools. Okay. And this is going to be arranged by APR. And again, we go, APR, it's not the only variable, but this can often kind of just get you started in what you're searching for. And straight out of the gate, you go, oh, look at that. Wrapped ETH USDC. Oh, USDC and Chainlink. Well, I recognize USDC, obviously. I recognize ETH. I recognize Link. These are blue chip asset that would be great pairs. And we're even looking at a USDC Aave pair, 133%. Okay, so this is just kind of like to get you started to go, okay, there's some pretty good blue chip pairs out there. Over here is the silly stuff that I mentioned to never do. And I can guarantee someone, either here on the live or on the replay, after we're done, or even while I'm talking, is going to go try to get into this one at just under 5,600%. Even though I'm telling you with no sarcasm, don't do it. It's a bad play. You will get in trouble. You will lose money. Guarantee you someone's going to do it. Okay. I don't know why. That's how people operate. So we see this about 5,600% APR with this wacky pair. What is this? I don't know. There's not even an icon there. This is arranging by best APR. Okay. Now, if I scroll down, I can even say, hey, I want to filter by, let's do 30-day APR. And I'm going to click here and it's going to filter. Now it's going to give me the best APR first. But again, I don't want to do that. I'm just letting you know you can filter by APR. I don't recommend it. It's a bad idea. Instead, what I'm going to do to begin my search, this is like a research phase, okay? What I'm going to do to begin my search is I'm going to filter by 24-hour volume. Because what did I just tell you before? We want to take a look at APR, yeah, but trade volume, then the TVL, then the volume to TVL ratio. That's kind of like the magic formula. Again, no guarantees, but it's a good place to start if you're just like staring at the screen going like, it's just a bunch of numbers and rows and columns. I don't even know where to begin. Well, I'm going to tell you where to begin. Come to 24-hour volume, click this little sort button, and all of a sudden, you're going to get now not the top APRs straight out of the gate. Instead, you're going to get the highest traded pairs. Now, here's 24-hour volume, and this is ETH USDC. Okay, so we would expect a really high trade volume on ETH and USDC. And you go, but it's only 42%. Well, yeah, but look at the trade volume to TVL ratio. Okay, the trade volume is actually higher than the TVL, which is a good sign, a good healthy sign. And you can see here it even gives you the ratio 24-hour volume divided by TVL. It's over 347%. That's definitely better than the 1-to-1 or better that we talked about. But because the fee tier over here is so low, because it's a popular pair, that's why this doesn't translate to over 50%. Okay. Like I said, it's never a guarantee. It's just kind of like a general rubric. So if I'm looking for pairs, and oh, see, this one has a lower fee tier, but it's a higher APR because the TVL is lower, even though the volume is also lower. So remember, we talked about all the fees being distributed across the holders. So if there's fewer holders, even, I mean, we're still at 2.4 million TVL. That's still a healthy pool. But the ratio here is almost 20 to 1 volume to TVL. but the fee tier is also a lot lower. That's why we get this 49%. Now, for me personally, I tend to skew towards the more reliable and conservative kind of plays. So I might even open up a position with this one because even though it says 49% now, I know, or I should say, it is, in all likelihood, it's safe to assume that as the market heats up even more, as we approach the hottest part of the bull market, that the trade volume will increase and that will likely go up. Okay. But for now, okay, I'm just going to make a mental note. Hey, 49% ETH USDC, that's not a bad percentage. Okay, and then I'm gonna scroll down more and I go, oh, here's Arbitrum USDC. Well, I'm on the Arbitrum network. That's the native token for there. Okay, this is pretty good. 77%. Not bad. Now you'll notice down here, I've got 38 pages. And I go, oof, I don't know if I want to slog through 38 pages. So how can I narrow this even further? Well, I'm filtered by 24-hour volume. Now I've got this handy little search bar here. And I can say, you know what? I think today, because I want to keep the demo as simple as possible, I only want the pairs with wrapped ETH. So I type in my WETH there on the search bar. And now this is going to show me only pairs where at least one of the components of the pair is wrapped Ethereum. All right. And again, I've got the wrapped Ethereum USDC. Here's my wrapped Bitcoin wrapped Ethereum. And remember, I said if you get 20 to 30% on that, you're doing very well. So that's, I mean, you can see right now this is just under 20%. That's what I would expect on a pair like that because it is kind of like the golden the golden boy pair. So again, I'm going to kind of scroll down here and I go, oh, look at this. Here's an ETH USDC pair, 0.3% fee tier, pretty good TVL. Trade volume is almost to the 1-to-1, so it's getting there. And I'm at 62%. I would keep that one in mind as well. But I'm going to keep browsing. I'm going to go to page 2 and see what I can find. Here's CRV ETH. All right, all this looks great. So now I say, all right, this is telling me best blue chip pairs. I've done a little research. What if I just want to do ETH in a stable coin? That's really all I'm after. So let me do ETH and USDC, and then it's going to show me all of the possible pairs. And then if I wanted to, now that I'm searching only these, I could sort by APR to find out what the top APR pairs are going to be. And here we are. If I want ETH USDC, looks like right now 62% is going to be about my highest. Now, again, that's the displayed APR, and it's only taking into account, in this case, the last 30 days. Well, what about just the last 7 days? Whoa, 90%? It's a pretty big difference, isn't it? It's basically saying if you factored in an average of the last 30 days, which there were times of low trade volume there, you're estimated at 62%. If you only account for the last 7 days as things are starting to heat up, we're up to 90% estimated APR. Why does this matter? Because they fluctuate, okay? And the fluctuations are what will drive you bonkers bananas if you don't expect them to occur. If you expect them to occur, all of a sudden you go, oh, okay, that's what's supposed to happen. It's supposed to tell me 90% this week, and then 62% the next week, and then 130% the next week, and then 72% the next week. That is normal because the estimated APR is estimated based on retrospect and it's looking forward to a future that we don't yet know, which is why we keep the range 50 to 100% in mind because I don't know what your actual APR return is going to be. All right. No one knows. It's based on trade volume. If everyone stops trading for a week, I don't think that would ever happen. But if everyone just stopped trading for a week, this estimated APR would show 0%. And you go, it's broken. It doesn't work for me. Blah. You freak out. But if you go, oh, wait, hold on a second. There was a lull in trade volume. And then the next week, the trade volume spikes and you get 300%. You don't freak out either to the positive side. You go, oh, 300%. It's great that I got that for a week, but I know it's not going to last, especially on a blue chip pair like Ethereum USDC. All right, so now I've got in mind, this looks like a good pair. I'm just going to check USDT. And again, I could search all kinds of different stablecoins because now there's a lot of them coming out. But for now, I'm just going to search for ETH USD. Oh, it looks like there are no pairs for that available right now. Okay, great. That makes my search easier. There we go. So I've got ETH and USDC. As a side note, just a fun side note, stablecoin pools. This is pairing stablecoin because people trade those USDC for USDT, DAI for USDT. Oh, I searched for it the wrong way. I don't know how to type that funny T. Um, what I just now noticed, it's displaying this. Maybe I can copy this. It's displaying this as yeah. So I would have to do that. There's my ETH. I thought it was weird that ETH and USDT wasn't available. So again, I'm going to get some pretty similar percentages here. And it looks like USDC is going to be the winner in this case. But what I wanted to say was these stablecoin pools, these are two stablecoins, meaning if you wanted like the safest return for this method, for this strategy, you could pair two stablecoins together. You're going to get probably 12 to 15% is actually really, really good, but your base capital is not going to go up or down. So safe in the sense that it's not going to go down unless the whole stablecoin implodes on itself, but also it's not going to increase in value. This would be like if you just wanted a safe, reliable play where you go, I just want to get 10% a year in crypto. That's what you'd do. You'd probably pair up two stable coins and you're off to the races at that point. Okay. This is the much slower method, and we're not going to do that. I just want to make you all aware that there are also those opportunities in crypto. We're keeping our 50 to 100% in mind though. All right. ETH USDC. I want to open a position here. Okay. I am going to click here and it will redirect me to the setup. And here you'll see price range. Get this a little bit better. Here we go. Price range. Now, the default is based on the price action over the last 30-ish days or so. All right. So it's just going to give you a suggested range. You don't have to take this suggested range. And typically it will give you a suggested range where the current price is exactly in the center, meaning the ends are equidistant from the current market value. And then down here, it'll give you that estimated APR. Okay. So here's what you have to take into consideration for range. And this is when people were talking about what about rebalancing? What if I go out of range? What do I do? And if you're new to this, you might think, I don't understand those words, Brandon. What does that even mean? Here's what it means. Let's say I open a position and we're talking about what's called V3, concentrated liquidity. Here's my range. And let's say I'm doing my ETH USDC. And let's say whatever it is, 3,500-ish is about the price of ETH right now. So that's my midpoint. That's the current market rate. Now, let's say I'm just going to pick random numbers here. Let's say I put 4,000 as my end range here and 3,000 as my bottom range. So 3 to 4,000 is my range. When ETH trades somewhere between 3 and 4,000, I am going to collect fees because I'm in range. All right. Now, if I fall out of range, I stop collecting fees for that position for that period of time when it's out of range. Okay. So if ETH spikes up to 4,100 tomorrow, I am now out of range. That position doesn't collect fees. But if the next day ETH drops back down to 3,700, I'm back in range. Okay. So because we don't know exactly what the short-term price action is going to be, we want to set a range that allows us to ideally stay within range for as long as possible, knowing full well that there might come a time when I go out of range completely And yeah, I could rebalance, or the other option is to remove liquidity. So I would say, hey, I put my liquidity in, trade, 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 trade. Great, lasted for 6 months. Now I'm going to remove liquidity. I still have the assets that I put in there in the first place, and I have 3, 6, 9, 12 months worth of trading fees that I accumulated during the time I was in range. Now, here's the thing that usually freaks people out when they don't understand what's going on. When I start my position, assuming that I put current market price directly in the middle of my range, I'm going to have about a 50-50 ratio between ETH and USDC. Meaning if I put in $1,000, about 500 of that will be in the form of Ethereum, and about 500 of that will be in the form of USDC. Now, as my position fluctuates, it goes up here, it comes back down, it goes up again, it goes back and forth and back and forth. Okay, that's the chart. That's the chart doing its thing. There's the chart. Woo, nice chart. Okay, as it fluctuates, so too will the ratio of my assets fluctuate. Fluctuate. It's not permanent. And this is where we get the phrase impermanent loss. Okay, because it's not permanent unless you click a button to make it permanent. That's why it's critical. Okay, so now if ETH goes up to 3,800, my range is set at 4,000 to 3,000. If ETH goes up to 3,800, now my ratio, and I don't know what the exact ratio will be, so I'm kind of making up numbers here, but just to illustrate the principle. But let's say that makes it 80-20, meaning I'm going to be 80% of my position is now in the form of USDC, whereas 20% of my position will now be in the form of ETH. And so if I go completely out of range on the top end, I'm now 100% USDC. If I go out of range over here, I'm going to be 100% Ethereum. Now, that is a temporary state unless you remove liquidity. So here's what happens. Here's what drives people nuts. They go, oh, I got in at 3,500. And let's just pretend for the sake of illustration that you bought ETH straight up. You didn't have any, you just bought some, okay? You got in for 3,500 and it goes down. Now it's only worth 2,900 and your position has been converted to 100% ETH. People look at the dollar value on the day and go, I lost. I thought this was supposed to make me money, Brandon. I lost money. It doesn't work. Well, no, what happened was you started with ETH USDC. The value of ETH went down like it does. We're just making up an example, right? That's not an unrealistic possibility. ETH goes down temporarily. And the value of your position, say you started with $1,000 worth of ETH in USDC, and now the value of your position is, and again, I'd have to calculate all the math. I don't know, but let's just pretend it's $700. And you go, I lost money. What's the deal? What's going on? Well, the value of ETH temporarily went down, and your position got converted to 100% ETH, but you now have more Ethereum than when you started. That's the kicker. So even though the dollar value today looks like less dollar value than it was 7 days ago or whenever you started, you have more Ethereum. And you go, oh, well, gosh, that's actually not so bad. I can either wait for this to come back in range and start collecting fees again and the value goes up, or worst case scenario, I remove liquidity, but I end up with more Ethereum than when I started. That's why it's so critical to choose blue chip assets. So let's say I chose for my pair wrapped Ethereum and Link. If I go out of range on one side, I get 100% Ethereum. If I go out of range on the other side, I get 100% Link. If I have paired two assets that I love and would hold anyway, it won't bother me. In theory, humans being humans, we freak out about stuff. In theory, it won't bother me that I got more ETH or more Link. because I go, oh, well, that's a win either way, because now I have more of one of these two assets that I was planning on accumulating more of anyway. Okay. So I know this part of the lesson typically is the most confusing part. I also know that I'll explain it to you today and you'll think you understand it. And then depending on where you're at in your crypto journey, tomorrow you won't understand it. And you go, wait a second. He said something about ranges and ratios and you're gonna have to come back and review this. That's okay. All right. Most people, when they first get exposed to this part of the dynamic and how it works, most people don't get it at first, which is why people always ask about impermanent loss, and which is why I go, don't drive yourself crazy about that yet, because it's a negligible factor and you're going to think you understand it, but really what you're going to see is value of ETH go down, and you're going to say, oh, impermanent loss. That's not impermanent loss. That is the regular expected fluctuation of crypto assets. That is not impermanent loss. All right. Now you're also going to drive yourself crazy going like, well, didn't I lose? It's impermanent loss. No, it's not. You think it is. It's not. All right. So all that said, let's switch gears back to the tactical here. And I'm going to say, all right, I'm just going to do this again. I'm just doing an example here. Oops. I'm going to set my minimum at 3,000. I'm going to set my max at 4,000. And that's a pretty tight range, but again, we're just doing a demo here, so it's okay. And I'm going to scroll down and get my estimated yearly APR. Okay, we're still at 73%. That's pretty good. Got no problem with that. Now, you'll notice a few things. Number one, auto select price range. I can pick narrow range, wide range, full range. If you're brand new, you can just start with these. You can go, narrow range. That's pretty narrow. I want wide range. Oh, that's pretty wide. That'll give me right here 30%, 30%, and narrow gives me 5%, 5%. Okay. If I wanted to say, oh gosh, I want this to be in percentages, like 10% on either side, I can toggle this here and just say I want 10%, 10%. Boom, yearly APR 105. Okay. Now that doesn't allow for very much fluctuation. So I'm actually going to kick it back to where I was before. And that's actually like, what is that? About 15%, 12%. Okay. So I've got my range set. Now what I want to do is check my automation settings here because often it will automatically by default toggle on automations, auto rebalance at minimum and maximum. Again, don't do that yet. Okay. Automations are the purpose of them is to automate a process that you already know how to do manually. If you're not well equipped to do it manually, you should not be doing it automatically. All right, so I'm going to toggle these off. And then a lot of these other tools, we're not going to get into this today. These are to calculate impermanent loss and drive yourself crazy and depositing liquidity, estimating how much you return, all this stuff. Okay. I'm more concerned with, do I have a blue chip pair? Is the APR within my reasonable range? And does the TVL to 24-hour volume ratio fit my criteria? Okay. On the most basic level, if that's all you consider, you'll still do pretty well. Okay. There are more nuances, there's more variables, there's advanced training. But for the sake of like, hey, if I just wanted to get started in as short a time as possible and I wanted the simplest play that's still going to get me a killer return, here you go. Open an ETH USDC pair. There are many other pairs that are perfectly appropriate, very profitable. It's just that this is an easy one to do a demo for. Okay. So now I've got all my criteria set up here. And then I go, okay, I want to create this position. All right. It redirects me here. Now I have, all right. Yeah. I have a little bit of money here in Ethereum in this demo wallet. So this is ETH and USDC. Manual means I would need to have ETH and USDC in my wallet, or actually in this case, wrapped ETH. Mine is just ETH. I would have to first wrap it. I have to have both of those assets in my wallet. However, I'm going to select Zap in. And what this allows me to do is deposit just one of the assets. In this case, I'm going to deposit ETH. Crystal, on my behalf, is going to automatically swap a portion for wrapped ETH and a portion for USDC in order to make a pair that's perfectly balanced. So let's say I'm going to do my 0.25 here. That's about $889 worth of Ethereum. It's going to get me a quote. And it says, okay, based on the range that you chose, of the $889, you're going to need 524 in USDC, 363 in ETH. Now you'll notice that's not perfectly 50-50. Well, that's because I just set the range to 3,000, 4,000, and the current price is not exactly 3,500. It's almost 36. It's 3,558. So it's slightly off. So they do all the funky math for you so that you don't have to figure it all out. But they're basically saying if you contribute $889 worth of Ethereum right now, this will be the ratio of your pair, and it will be a wrapped ETH USDC pair. All right. That's what I want. So I click on Zap now. It's going to give me all my, hey, are you sure you want to do this? Yes, I want to confirm this. Confirm. Success. Boy, that was easy. Check new position. So now it's going to say, here's your portfolio. And oh, I already made 8 cents. Fantastic. Total value. So it's going to say, here's your deposits. Here's the total value. The total value over time will be your liquidity plus your earnings over here. And it'll let you know, hey, you deposited this much originally. So the dollar value that day of the assets you deposited. And then this is what the current dollar value today is of those assets. So I can come back and check on this. It's ETH USDC. I'd probably check on this one like once a week at the most. And then again, this will fluctuate, and I'm most concerned with the earnings from the trading fees. The profit and loss will say fluctuation in value of the underlying pair of assets plus earnings. So if tomorrow Ethereum drops down to 3,200 and it's only been 1 day of trading fees, this will show as a loss. It'll show up in red. And again, people go, I'm losing. Brandon, I thought you said this worked. Well, this is a bit of a misnomer here on the Crystal interface, profit and loss, because typically a P&L for a business is like once the profit or loss has already been locked in, we're reporting on it in retrospect. The profit and loss, as you see it here, is simply saying, here's where we're at today. But again, this fluctuates with the fluctuations of the market. So I'm not going to consider it a realized loss. I'm also not going to consider it a realized gain because it won't be realized until I remove liquidity from the position. All right. So I'm just going to, for now, in the short term, I'm going to keep an eye on the earnings because that's where I accumulate and it always is going to be net positive in this example, unless ETH tanks to the core of the earth and goes to zero, in which case all the Ethereum that I earned will be worth nothing. Which again, that's why you want to farm with blue chip pairs, so you don't run into a situation where one or both of the assets in the pair tank to zero. Okay. All right. We don't have to go through a ton of this right now. We can maybe touch on this later, but basically, this is just breaking down all the data. Here's your liquidity. You can increase liquidity. You can remove liquidity. Here's the current values. Here's the current ratio. So again, I'm at 41.59%, not perfectly 50-50, close to it. And this will change. So I'll come back later and this will say, 60-40, 30-70, 80-20, 50-50, whatever. That'll fluctuate. Here's the fees and rewards. It's going to tell me what's unclaimed versus claimed. And then, chart action. Here's your range. Here's the current Ethereum price action. There's just a lot of little like data points that you can check in on. Here's the history of this particular position. We don't really need to get into all of that right now. There are other variables in terms of like monitoring positions and making moves and rebalancing and whatnot. But for the sake of, again, simplicity, ETH USDC, Crystal.app, open a position. And this one I would say, hey, if you feel ready, try it. Try it with 50 bucks. Go in, click a few buttons, try it out. Why 50 bucks and not 50,000? Because you don't know yet, unless you've done this before, you don't know yet how you will react when things fluctuate. Okay. And we all want to believe, like most people don't think they're most people. We all want to believe that, no, no, Brandon, I'm super level-headed, always like I'll just look at it with a lens of just sheer logic and depth. No, you won't. Neither will I, by the way. I'm not like, it's not a dig on you or anyone here. It's just like that's what humans do. So until you know how you react, don't put a ton of money behind it. So usually in the mastermind, when people open their first position, we'll call them like a test position, and it'll be 50 bucks, 100 bucks, 200 bucks, whatever. It's just like it's small amounts, so you can watch the process work. That's what we did with the Sol USDC position was, hey, I put in a little bit. Let's just look at it every day and see what happens. And we go, oh, look, it fluctuated. Ooh, good thing we were expecting that, so we don't have a strong emotional reaction to it. Oh, it went up. Good thing we don't consider that a permanent gain because we know it could fluctuate again. Oh, the trading fees. Oh, that's what I'm really after. Let me do the calculations. Oh, I'm at 80%. Great. So having the experience of the position, even if it's a small amount, gives you real live data, feedback for yourself so that you can check yourself and know, oh, when XYZ happens, I tend to react in whatever way. That helps me monitor how I might act or behave in the future. Okay, I'm going to pause there. We've got a few minutes left. I noticed there's one Q&A, and then if anyone else has other questions, go ahead and drop them in the Q&A now. I'm available for the next 10 minutes, but again, if there's no questions, we can end a little early. No harm, no foul. Nicole, when the market goes parabolic, do you exit all of your liquidity pools? Well, that's a tricky question. I don't, because I don't know what the market's going to do. Now, when we consider hedged plays, because saying exit all of your liquidity pools because market go parabolic, that is not a hedged play. That is, I am chasing maximum possible upside. Again, not right or wrong, but you have to acknowledge that is not a hedged play. And like we were talking about with the session with Nick, do your actions align with your stated values, like intention, intervention? If you say, I'm going to do this, and then you do the exact opposite, well, you're not behaving with integrity. But if you just change what you say you're going to do to line up with what you do, you are acting in integrity. So if you say, I would like to behave in such a way to chase maximum possible upside, and then you remove all your liquidity positions when the market starts to like really heat up, then you're behaving with integrity. And it's fine. There's nothing wrong with that. I'm simply acknowledging for me and for everyone that we instruct and mentor in the mastermind, we'll typically give guidance towards the hedged play, which would be the barbell, the bimodal strategy, which is sometimes you have liquidity pairs. These produce yield. One of the things to do with that yield is stored over here unpaired, because now on this side, my aim is to capture max possible upside, but on the reliable side, I'm hedged. So now I have the balance between the two. So exit all my liquidity pools? I wouldn't, but I would say if I've been in liquidity pools and I have enough accumulated yield, and in this situation, let's say I was accumulating ETH and USDC, I would probably, as I harvest the yield, I would swap the USDC for ETH or something else, maybe a portion of it for Pepe and Dogecoin, a small portion. And then I would hold that in a separate wallet unpaired. So when we talk liquidity pairs, you don't necessarily want 100% of your crypto portfolio in liquidity pairs. If I have 100,000 in crypto, and this is personal preference, I might put 80% of that in pairs, I might put 50% in pairs, I might put 20% in pairs, depending on personal preference and goals and timeline, all these like individual factors. So the idea is, yeah, the market's going to go parabolic and I'm planning on selling and realizing some gains. I probably would want a little bit of Sol unpaired, a little bit of ETH unpaired, a little bit of Bitcoin unpaired. Okay, maybe some BNB if I'm planning on selling a portion or all of that on the next big leg up. Now, the flip side of that is if I open a liquidity position of ETH USDC and I set my upper range to, let's say, 6,000 for ETH, if ETH goes above 6,000, I get converted automatically to 100% USDC. In effect, I have DCA'd out of Ethereum for whatever money I put in that position. I've DCA'd out of Ethereum into USDC. Well, Nicole, that's what you're talking about anyways. Hey, when the market goes parabolic, I want to sell some of this for a profit. Well, guess what? If you're in a liquidity position with a wide range with a cushion to the upside, you are already planning on DCAing out if the market goes parabolic. If the market doesn't go parabolic or doesn't go as high as you wanted it to, you're still safe because what happens? You collect fees while all that happens and then comes back down and you're back to where you started in terms of ratio of the two assets. So yeah, just I know that's kind of a long answer to what you asked, but basically just acknowledge what you're after and acknowledge, hey, do I want to follow this strategy and take a hedged play, or do I want to just chase max possible upside? In which case, none of this really matters anyway. Like just hold Ethereum until it moons and then sell it all. Renata, are there any plays you can do based on news that comes out? For instance, if the government decides to invest in aviation industry or defense industry, is it wise to buy on that information? Well, it's neither wise nor unwise because it's still all speculation. And especially when you get into like listening to mainstream news, like some of it is facts, but a lot of it's like they say the news can't tell you what to think, but it can tell you what to think about. And that is in and of itself a bias. So if the news only reports on certain things, you'll tend to only think about those things if you're reading that news. Meaning every cycle, China bans Bitcoin. Now, they never really banned Bitcoin, but there's every 6 months there's an article, oh, China's going to ban Bitcoin. And then what happens? The price of Bitcoin goes down. And savvy investors are going, time to buy, baby. Because the news in that case is all just like fear-based, right? So me personally, I don't put a lot of I don't make big moves based on mainstream news. Um, but there are instances where the mainstream news can let you know that big things are about to happen. So, for example, all of a sudden the news is reporting on, look at all the cool new crypto bills that are being passed. Look at all the mass adoption. Look at all the big billionaire hedge funds that are getting in. That's right now, that's your signal that, like, okay, probably the mass market is now becoming aware of the opportunity. And yes, that could affect price action on the chart. Is there a recommended platform for LP, Orca versus Crystal, or something else? Between Orca and Crystal, you have pretty much everything that you need. Yeah, there are others, but it's like with Crystal, you can access most of them. Aerodrome, Uniswap, PancakeSwap, Radium now even Solana is even you don't even actually need Orca. I just like Orca. You can get into Solana pairs on Crystal as well. Are there any crypto type plays based on those industries, or is that not relevant? I'm not sure what you're asking. I think that's the same question as before. Uh, do you do a lot of lending and borrowing as well? Nicole, I dabble in that a little bit. It's not my main play at this stage, but I fully acknowledge that if you are already very proficient at this side of things, there is space to also add a layer of a lending network. So, for example, I could take the yield that I generate from these activities and I could put that as collateral and then borrow against it. Because anytime you're borrowing, especially if you're borrowing variable assets, then you've got your liquidation factor. And if you ever go get caught in a position where the asset that you're borrowing or the the value of it fluctuates to the point where you get liquidated, you can lose a lot. And so unless you're doing like provide stablecoin, borrow stablecoin, and then that's a different game. But anytime you're lending and borrowing crypto assets, it's the most hedged move to only do that with house money, which would be the yield that you generate from something like this. The only time I would ever put base capital on something like a lending network would be, like I said, if I'm providing stablecoin and then borrowing a really low LTV percentage against that stablecoin for more stablecoin. How long have you been in crypto again? I mean, I first got started, oh gosh, like 2019-ish. I don't even remember the exact time when I first got in, but that was like, a friend tells me to open a Coinbase account and buy Link, and I'm like, okay, and I just did that. I haven't been doing it like this kind of stuff for that full time. But let's see, the mastermind we launched in February of 23. That was about 3.5 years ago. So probably about 4.5-ish to 5 years, somewhere around there. Yeah, I don't know the exact timeline. I heard that the looping could be lucrative, but I do get scared of the liquidation factor. Yeah, so Nicole, when you say, just for those who may not be familiar with that term, looping is what you do when you take a lot of these different tactics and you put them in basically like a flywheel so that they're all like feeding off of each other. And typically in that loop, you would include a lending network. But yes, Nicole, to your point, like there's risks involved there. And if you don't fully understand liquidation factor and how it works, definitely don't get into crypto lending and borrowing. But if you do understand it, then yeah, again, if you want a hedged play, take some yield. So you put in, let's say, 50,000 into blue chip pairs and you start yielding, conservatively, let's say 3 to 5% a month. And you can take that 5% and go, okay, now I'm going to put this, I'm going to lend, I'm going to put it as collateral, I'm going to borrow against it, and then I'm going to put it back into a different liquidity pair. That could be a play. You just got to, again, just be really careful and proceed with caution. Is this your main income? How successful have you been if you don't mind sharing? Just to be blunt, I do mind sharing exact figures because I don't want the IRS knowing how much I have. That might sound paranoid, but that's the reality. But no, it is not my main income. It is one of my sources of income. I run a business. Obviously, the mastermind is a business that produces income as well. And then right now, I am not spending any of the yield that I generate. So one of my personal goals is to not have to use any of the yield to pay for daily living expenses, because then I can compound everything, which significantly shortens my time horizon. So we talk about setting up the goal, setting up the long-term vision, and then at some point, we might be able to what is called collapse time, meaning just shorten the time that it would normally take you to reach that big picture outcome. What's the soul pair at you set up the other day? We'll check in on it tomorrow. We'll stick with what we got today for the ETH and the USDC. Tomorrow we'll be able to see, okay, from the time we started until 6 days later, we'll know what the total return is, and then we can reverse engineer that. Because previously we've just been seeing daily estimates for the APR. Now we can say, hey, for the whole week, again, it's just one slice in time. Hey, for the whole week, our estimated yearly APR is going to be whatever, 70%, 72%, 80%. I don't know exactly what it's going to be. But yeah, we'll get sort of a more definitive answer on that. All right, cool. We're at the top of the hour. I don't see any more questions, so I'll wrap up the session for now. We'll send out the replay later. It's the weekend. I might not do it today if I don't feel like it. But regardless, what I'll probably end up doing is I'll make the replays available through end of day Monday, just so everyone has like one final day to watch everything. And then these really are, I'm not going to make the replays available anymore for free. There will be an opportunity to purchase the replays if you want to like catch up after the fact and watch them later. But the whole premise of this was, hey, join us live or watch a replay every day. and keep up to speed with what's going on because it really doesn't do you any good to watch one and then do nothing with it. It's really meant to be consumed as like an entire process and an entire series. So anyway, all that to say, thanks again, everyone. And we will be back here tomorrow. Yes, it's Sunday, but we're going to do one more day of the Crypto Profit Accelerator. We're going to kind of talk big picture, wrap things up. We're going to talk about the mastermind a little more in detail. And I'll again open it up for questions, and we can be a little more interactive throughout the whole process. So it's kind of like 6 days of teaching, and then the seventh day there's going to be a little bit new stuff, but it's going to mostly be reviewing the essentials, talking about, hey, looking forward to the future. If I want to implement this on a regular basis, what's the best plan of action to that end? All right. Thanks again, everyone. I will see you tomorrow.